Anthony Grasso here, bringing you financial news that you could use. In this particular video, I'm going to do a stock analysis review on Honeywell. Is this giant behemoth a company worth investing in right now? Well, let's find out together. I'm going to go over a summary of the company, its product offerings, recent headline news, financials, analyst predictions, and then finally I'm going to give my buy, hold, or sell recommendation for both your short-term and long-term growth investors out there. And as always, folks, don't forget to smash that like button down below. Definitely helps. And consider subscribing. Hit that notification bell if you like to hear daily stock reviews and recommendations from unbiased source. So let's get right into it. So this video is brought to you by Webull, of course. It's an online brokerage trading platform where you can buy stocks, options, ETFs, and cryptocurrencies. If you sign up today and deposit any amount, you can get up to 12 free stocks by using my referral link in the description down below. All right, so what is Honeywell? Honeywell is a global multi-industry behemoth with one of the largest installed bases of equipment. The firm operates through 4 business segments, including aerospace, building technologies, performance materials and technologies, and safety and productivity solutions. Now, in recent years, the firm has made several portfolio changes, including the addition of Intelligrated in 2016, as well as spins of Garrett Technologies and Residio in 2018. In 2019, the firm launched Honeywell's Forge, which is its enterprise performance management software solution that leverages the firm's domain expertise in buildings, airlines, and critical infrastructure. Now let's look at some of the news over the past couple months that hit the company. All right, so the first one we're going to go over is last month they came out with their Q2 earnings and revenues, which surpassed estimates. Now, it posted better than expected second quarter earnings last month, while lifting its full year sales forecast, thanks in part to impressive gain in Industrial Group's commercial aerospace division. Now, Honeywell said the adjusted earnings for the 3 months ended in June were pegged at $2.10 per share, up 4% from the same period last year, and firmly ahead the street consensus forecast of $4.03 per share. Now, the revenues edged up about 1.6% higher to $8.9 billion compared to the analyst forecast of $8.67 billion tally. Now, looking into the current financial year, Honeywell said it sees revenues between $35.4 billion and $36.4 billion. Organic sales growth of between 5% and 7%, up from its prior forecast of between 4% and 7% to a range of $35.5 billion to $36.1 billion. Now, the Honeywell's adjusted earnings was between $8.50 to $8.80 per share. Definitely good news that they beat their numbers. All right, and then recently they did announce a quarterly dividend. But before I get in the quarterly dividend, let's go back for a second and see what the CEO Darius Adamski said. He said during that Q2 results, he said, while we recognize macro cross currents are clouding the global economic growth outlook, he remains confident in our demand outlook for the back half of the year, with orders up 12% year over year and closing backlog of $29.5 billion, up 12% year over year, led by their long cycle businesses, which will help growth, drive growth for quarters to come. And I do agree with him on that sentiment. So last month also, they announced that they declared a regular quarterly dividend payment of 98 cents per share on the company's outstanding common stock. Now, the dividend is payable on September 2nd out of the surplus of shareholders of record at the close of business August 12th. So it's too late to get on that dividend, but that was definitely good news that they're keeping with their dividend payments. Now, let's go ahead and look at some of the fundamentals of this company right now and see how well it's doing. All right, so the company is currently trading at $195.23 a share, down 2.5%. Now, the Fed Reserve just met today, and it doesn't look good, and the Dow just tanked. So there's a tanking in a lot of stocks right now. So it's down, roughly 2.5%, $5. It was at $200 a share to start. All right, it has a market capitalization of roughly $131.9 billion. Now, the company's projected to have $35.71 billion of revenue for 2022, with earnings of $5.6 billion. Now, the revenues are projected to increase over the next few years to around $40.25 billion by the end of 2024, with a positive $7.25 billion in earnings. So the forecasted earnings growth is around 12.5% per year, and its revenues are forecast to grow around 6.2%. So the earnings are going to go up higher than the revenue, which is good. Their efficiencies. So I want to consider that high growth earnings or revenues, but I would say they're high quality earnings and revenues. Now let's look at some valuation measures, some key measures of the company. Let's do some analytic work real quick on this company. So because the company is in the industrial conglomerates industry and has positive earnings, the price to earnings growth and the price to earnings, the PEG and the PE, and the price to book ratios are the most appropriate valuation measures. The price to sales ratio is less instructive than the PEG or PE since the company has positive earnings. Therefore, Honeywell seems inexpensive with a PEG value of 2.92 times below the industrial conglomerates industry median, a PEG of 4.21. All through, the PE ratio is 26.6 times, which is above the industry median, which is only 20.31 times. So I'm going to get into that later on, but with the growth, it needs to hit every single mark to keep that PE ratio up, but I'll get into that. Now, it is expensive based on its price to earnings ratio compared to the peer average as well of 23 times. Now, if you look at the price to earnings ratio versus the fair ratio, this is the expected PE ratio taking into account the company's forecasted earnings growth, profit margins, and other risk factors. It seems like a good value based on its price to earnings ratio of 26.6 compared to the fair estimated price to earnings ratio of 29 times. But now if you look at the share price versus the fair value when looking at future cash flows, though, for this estimate, we use the discounted cash flow model, and it's trading below the estimate of fair value, which we put at $313 a share. Now, if you look at the profitability of this company, the profitability numbers, it's one of the more profitable companies in the industry with a net margin of 14.7%. Its net margin and operating margin are both among the strongest of any of its peers, while its gross margin is in line with the industry median. Now, the current net profit margins of 14.7 are higher than last year, which were 14.6%. And they're definitely going to be growing a little bit in the next 2 years. So let's look at the dividends of the company. Well, the annual dividend is roughly $3.92 a share. At its current price, it yields around 1.96%. It's a level that is in line with both the industry's average and the S&P 500. Additionally, this company is in the minority as most others in the industry do not even pay a dividend. So it's a notable dividend, and the dividends per share have been stable for the past 10 years. And the dividend payments have increased over that time frame as well. So dividend looks good into the future if you would like to get dividend payments out of a company. Now let's look at the growth of the company. Now the earnings growth outpaced the revenue growth of the past trailing 12 months. This is a trend that is not sustainable if profits are to continue to grow at this rate. However, though, the result was better than that of the average company in the industrial sector. Now, the earnings trend, they have grown about 8.1% per year over the past 5 years. It's had a good earnings trend. Now, finally, if we look at the financial strength of this company, it has a debt to total capital ratio of around 56.3%, which is in line with the industrial average. Now, given that the company's operating profits are 27.7 times, that is greater than the interest payments. There should be little difficulty in repaying debt. Now, the debt to equity ratio is considered a little high, though, to me. And the short-term assets of $23.8 billion exceed both its short-term liabilities of $19.9 billion, but does not cover its long-term liabilities of $24.1 billion. Now, the debt is well covered by operating cash flow, though, of 24.4%. And the interest payments on its debt are well covered by earnings before interest and taxes. They have a 27.7 times coverage, which is excellent. So what do the analysts say specifically regarding Honeywell? All right. Well, the average consensus is a buy. I mean, there's 40% saying hold, 36 saying buy, and 20% saying buy. I think most of those hold are based on the current macroeconomic conditions that we're currently in, with rising interest rates and the recession that we're going into. So the average price target is $204.96 a share, with a high end of being $226 and a low end of $183 a share. Now, going over a few of the analyst reports real quick. So the Street Quant Ratings has a buy recommendation on this company. This is driven by multiple of strengths, which they believe should have a greater impact than any of the weaknesses, and should give the investors a better performance opportunity than most of the stocks they cover. The company's strengths can be seen in multiple of areas, such as the revenue growth, notable return on equity, reasonable valuation levels, and expanding profit margins. They say, the Street Quant Ratings say reasonable valuation levels, but it's definitely overvalued. What's reasonable to them is not reasonable completely for other people. Now, they also say that they feel the strengths outweigh the fact that the company has had subpar growth in net income. All right, so the Ford Equity Research Report has a hold recommendation on this company. It's a result of their systematic analysis of the three basic characteristics that they look at. They look at earning strength, relative valuation, and recent stock price movements. They said the company has produced a positive trend in earnings per share over the past 5 quarters. However, while recent estimates for the company have been lowered by analysts, Honeywell has posted better than expected results. Based on operating earnings yield, the company is about fairly valued when compared to all the companies they cover, and share price changes over the past year indicates that Honeywell will perform poorly over the near term. Well, it's definitely performed poorly today. I can give them that. All right, so finally, the CFRA report has a strong sell recommendation on this company. And they say the valuation is too optimistic on long-term growth. Now, the Honeywell's key commercial aviation end market will likely see below peak demand for at least 2 more years due to excess inventory at major OEMs, or the major OEM, Boeing. Now, Honeywell could also see a long-term weakness if business travel fails to fully recover post-pandemic. Now, I don't think that's going to be too much of an issue. I see a lot of people traveling right now. Now, Honeywell's commercial building end market will likely see a long-term slump. 2, as interest rates rise and many office tenants downsize in favor of more work from home. There was this huge push that I saw to work from home, but I also saw these companies just start taking people back and said, if you don't work in the office, you don't work here. And finally, oil and gas customers are facing material long-term risk from developed economies pushing anti-carbon regulation and electric vehicles rapidly gaining market share. Well, those are the analyst reports, and let me bring it back over here. So what are my thoughts? Am I a buy, hold, or sell recommendation on Honeywell? Here are my thoughts. Now, Honeywell is making several bets in mission-critical end markets that should yield triple-digit internal rate of return, IRR, over the long term, including in quantum computing and building automation. Honeywell has one of the strongest balance sheets in the multi-industry universe, and the company has a history of under-promising and over-delivering on its targets. With approximately 60% of its portfolio in short-cycle businesses, and with the remaining portfolio in end markets like aerospace and oil and gas, I think Honeywell is poised to outperform in 2022 with the value cyclical reopening trade. I view Honeywell as one of the highest quality companies in the diversified industrial space. The firm has an increasing ability to leverage its software technology across its industrial base. This software technology is integrated in both mission-critical operations, as in cockpit control during commercial aircraft flights, and in customer operations, though diverse offerings like warehouse automation in factories or connected solutions in buildings. Now, over the next 5 years, Honeywell is capable of decent growth and a small bump up in its operating profit margins. Now, Honeywell also is in the early stage for investing in a quantum computing, which represents a jump in technology. And there are multiple use cases in fast-growing industries, such as cybersecurity. So based on all of that, I am a buy recommendation on Honeywell, and I put a 12-month price target of around $215 a share. Now, I see healthy near-term earnings per share growth for Honeywell, but also, but given some serious risks to key end markets, though, I don't expect the long-term earnings per share growth will beat the market overall. This makes the share's premium valuation of 21 times forward earnings per share, 26 times, versus 18 times for the S&P 500, hard to justify in my view. Now, Honeywell trades at a premium to the sum of its parts value, and the stock price is crowded trade that bakes in a lot of optimism and requires near perfect execution to justify its assessment. But my bet is that it will. I think they're going to overperform over the next 6 months and 2023. Now, Honeywell's large organic bets like quantum computing or its partnership like S&P are promising, but we won't move the needle in the median term, which poses problems with rising interest rates. Now, commercial aerospace still faces considerable headwinds as passengers have been deferring travel for many months, and about 40% of Honeywell sales came from commercial aerospace and oil and gas. Now, those are the key risks that are for the long-term stagnation that possibly might be foreseen in the commercial buildings and oil and gas demand would to fail to materialize. But what are your thoughts? Or do you think these risks that I just said are going to outweigh the growth of Honeywell over the next coming quarters or year? Or are you a bull like me and say they're definitely going to underpromise and overdeliver? But there you have it, folks. And as always, don't forget to smash that like button down below. Definitely helps. And consider subscribing. Hit that notification bell to like your daily stock reviews and recommendations from an unbiased source. Until the next stock update video later today, folks. Ciao.